Liar, liar, pants on fire. You are most likely being lied to when applying for a mortgage. Did you ever notice how super friendly mortgage salespeople are? Now, they're also called loan officers and account executives on their business cards, but don't let the title fool you. They're just salespeople. So they're so charming because they want you to truly believe that they're your new best friend, so that you will trust in them and not shop interest rates or fees anywhere else. That warm and fuzzy rapport makes you feel like you can trust them the same way you trust your best friend. But it's designed to lock you in so you won't compare rates and fees elsewhere. However, once the mortgage closes and that large commission is paid, you will probably never hear from your new friend again, except for future business solicitations. Most people think their interest rate depends on their credit rating, but from my experience, it depends on how confident your mortgage salesperson feels that you're going to stay with him or her. The rate chart is a sliding scale, and the vibes that you put out is actually what makes your interest rate slide higher or lower. If you show that you are trusting, you're going to lose big. This is a sample rate sheet, not today's rates, of course, but your loan officer is going to choose a rate off of this sheet depending on how much commission he wants to earn. So if he feels like the rapport that you have is so strong, he might just give you the 5% rate and take 3.5% commission of your loan amount. Or if he feels like you might be shopping somewhere else and he doesn't want to lose you as a customer, he might give you the 4.25% rate and take a 0.569% commission instead. There's a huge difference in these two commissions. So it's smart to practice your poker face before you make that call. Say you're borrowing $300,000 based on the rate sheet that I showed you. So you told your mortgage guy up front that you were shopping rate and terms with 3 separate lenders. And your reactions to his charms are letting him know that his charm doesn't faze you one bit when it comes to business. Now, he gives you a lower interest rate than he initially planned. That reflects a modest commission to himself because he doesn't want to let you go to his competition when you shop. Your payment is now $14.76 per month because you outsmarted him and you received a 4.25% rate. His commission was about $1,200. Now, had you let him play you using his rehearsed charm, your monthly payment could have been well over $1,600 with a 5% rate, and his commission would have been well over $10,000. Over the course of a 30-year mortgage, that fraction of a difference in interest rates is about $50,000 on a $300,000 loan amount or $100,000 on a $600,000 loan amount. And many people have paid that extra $100,000 because they fell for the charm or they were just too busy to actually shop. But no one is too busy to just say they're shopping, whether you are or not. That lost money would have been better off in your kid's college fund or maybe your own retirement fund. Here's an easy way to calculate what a mortgage payment would be per thousand borrowed based on your interest rate and term. So for example, let's go to interest rate of 5%. Say you got a 5% rate. If it was a 15-year term, the payment would be $7.91 per thousand. If you got a 30-year term, the monthly payment would be $5.37 per thousand borrowed. And that's how it works. Feel free to screenshot this screen so you'll have this chart handy. Some mortgage brokers were asked by their clients why they were given a higher interest rate, and their friend got a much lower rate, and they have very similar credit scores. And a mortgage broker might answer, well, remember this late payment you made that shows on your credit report 5 years ago on your credit card? Well, this is affecting the rate that you're qualified for now. Lie, lie, lie. The underwriter typically only checks that there are no late payments in the past 2 years and did not care about any late payments that were 2 years old or more. That lie was just an excuse to give himself a much higher commission because he read your body language that you trusted him. Back in the early 2000s, the mortgage business was insane. People used their home equity to refi over and over again just to get cash out for frivolous reasons like to go on vacation or redecorate their house or pay off some credit cards. And they were paying like 10 and 20,000 in closing costs that were rolled into their loan, so they didn't even know they were paying it because it was just rolled into the principal balance of their loan. So anyway, appraisers competed for our business by appraising higher than the true value so we can make our insane commissions in exchange for them getting continued business from us. After all, which appraiser are you going to call when you know which ones appraise higher and which ones appraise lower? Right? So in our office, you would literally hear loan officers begging for stretches in value from appraisers because they had huge commissions riding on their deals. I actually had one appraiser that said to me, "I'll give you your value if you show me your legs," because one of his apprentices told him that I had great legs. I used to be a runner, but now my legs are not so great. But that appraiser's name was Farad, I remember, and we used to jokingly call him Farad. So all we cared about was that we were making more money than doctors, so it was great to us. But at that time, we were actually clueless that this would lead to the big crash of 2008 and the party would be over. This is what caused the real estate bubble to crash in 2008, and I feel bad that I was a part of it. Artificial home values on record by appraisers that let loan officers manipulate them into stretching home values to get their deals approved. And people using their homes as ATM machines by refinancing over and over again and not even realizing that tens of thousands of dollars of closing costs were being rolled into their principal mortgage balance. So after that, many people owed more on their mortgage than their homes were worth, and it led them to foreclosures when they realized that they were sold on refinances they couldn't really afford. So the foreclosures were at such a high rate that foreign investors stopped buying American mortgage notes on Wall Street, and the banks now had limited money to lend, so they tightened their approval guidelines. So the days of, "Oh, you had a bankruptcy yesterday? No problem. We have a loan for you today," that was now over. So why did they lend to people with bad credit? They didn't care because they were only going to sell the mortgage note on Wall Street to some rich investor in like Korea or some other country. So most American mortgage notes were owned by rich people in foreign countries, but because your local lender serviced the notes, people never even knew. My first mortgage job was in a subprime mortgage company that's name sounded similar to America West. It was such a cutthroat company that loan officers were making $10,000 to $20,000 and up on each mortgage by convincing clients that their credit was so bad that they had to give them an outrageously high interest rate. The driving force behind the madness was actually coming from the corporate office. They had competitions where the top 100 salespeople won a trip to Hawaii or Las Vegas with $5,000 cash bonuses monthly too. The people on top knew that customers were losing their homes, but they only cared about the massive amount of money that they earned flipping the outrageously priced mortgage notes to investors on Wall Street. Now, I was a top-ranking loan officer, but without scamming people. My secret was that I bought mortgage leads, like applications already filled out, from a good source online, instead of making 100 telemarketing calls per day like the other loan officers did. And I had a second secret, which was I gave my turned down customers a credit repair guide, and I told them to come back to me in 3 months after they did the step-by-step guide, and so they did. And I had steady business coming in because of that, and I didn't need to telemarket and scam people. I qualified for all the trips the honest way. In fact, I was number 2 in the entire region consistently. So winning trips and ranking high and all the bonuses were fantastic, but I was losing sleep at night because I was seeing people hurt by the scamming loan officers, and the corporate office rewarded their greedy behavior. So one lady called up, and I happened to answer the phone, and she was crying her eyes out saying, Sandra told me that my payment would be $1,600 per month with property taxes and insurance included, but I just found out that the $1,600 was just the mortgage payment alone, and I'm on a fixed income and I don't have any way to pay those property taxes and insurance. I'm going to foreclose now. And she was crying and crying. I felt so bad, but that was Sandra's way of competing for a trip to Hawaii. But this poor woman lost her home and ruined her credit just because of Sandra's lie. I then decided that I can't work for this shady company anymore, and I decided to leave and open up my own mortgage brokerage. So my husband and I ran the franchise together, and now we were able to do the right thing for people with honest, lower interest rates and terms, and sleep at night again. We kept the mortgage branch open for about 8 years, and then after the crash of 2008, when all the investors pulled out, it was just too difficult to get mortgages approved, so we just decided to close up shop. I went into real estate sales full-time, and he went into insurance sales. Since the crash of 2008, laws were changed. More specifically, the Dodd-Frank Act, which now protects consumers from most mortgage fraud. So appraisers can no longer communicate with loan officers or realtors, only the banks that hire them, and this helps avoid manipulating home values for personal commission gain. So loan officers must now show that there's a benefit to a refinance to avoid frivolous refinances, and commission amounts must be disclosed to the customer and no longer kept private. They also made the mortgage closing statement and truth in lending forms easier to read in layman's terms so all consumers can understand the terms. Shady sales tactics are used in all types of businesses where commissions are involved. You wouldn't even know that you were taken by charm until your bills arrived. So just remember, limit the small talk and be all business. Put on your poker face until all business is fully signed, sealed, and delivered. Then see if the salesperson still wants to be your friend after the sale is complete. My guess is he or she probably won't have time to even speak to you after the sale is done. It was a fake friendship attempt just to land your sale. They say those who can't do teach. Well, that's why I'm here teaching because I can't be fake. I can't get out there with the con artists and scam people. So yeah, I get some business, but they get more business than I do. So whatever. I hope this saves you thousands. As a realtor now, I tell my clients to tell their mortgage broker that they're shopping with 3 other lenders. But most don't listen to me, and they all fall for the same charm, and they end up paying $50,000 to $100,000 more when one simple sentence can save them thousands. I was there. I saw the meek and the trusting customers get stomped on the most.